This video is about understanding stock market resilience using the market resilience indexes in Focus 15 investing. The stock market has great gains sometimes, but it also experiences periodic losses. This chart shows the stock price levels of the stock market index for Japan, TOPIX, and the period is 1985 to 1995. And 1985 is actually when I joined the investment industry and began to evaluate money managers as a profession. And during the subsequent 5 years, stock prices moved higher, and it became very ingrained that it's important to maintain a stable allocation to stocks. And very often it was a 60% allocation to stocks, a 40% allocation to bonds. In about 1990, I was transferred to Japan to head the Tokyo office of our company, evaluating money managers and making recommendations to Japanese pension sponsors. And we talked to them about manager evaluation and also about asset allocation, always maintaining that it's a good idea to maintain a stable allocation to stocks because no one can time the market. And that view against market timing was deeply entrenched, and it's something that I thought was just a fact of life, that people can't time the market. But beginning in 1990, the Japanese stock market began to decline, and over the subsequent couple of years, it declined 61%. And so anyone we talked to about having a 60% allocation to stocks and a 40% allocation to bonds was hurt quite a bit by that decline. And that seared in my mind that avoiding stock market losses would be an important part to achieving higher return. But yet, over the subsequent 10 years, I professed quite adamantly that no one could time the market. The response to people experiencing these major declines, as shown in this chart, is that one must have a long-term time horizon, and that one must hold the position of 60% stocks over an entire market cycle in order to get the benefits. The general belief of stock market prices is that there's a strong event-driven component to it. That if we have price in the brown line moving horizontally across time, this is the early period stock prices moving generally higher and generally lower over time, that events such as event A would drive prices lower. And if bad event A takes place, the prices decline. And those events can include announced company growth figures, changing growth expectations of investors in general, news at the company, economy and political levels, and natural disasters. And it's a long list of the types of events that seemingly push stock prices lower. Good event B comes along and is positive and pushes stock prices higher. And good event B must be very strong because prices move past the point where event A occurred and continue higher. Event C must be very bad because stock prices move down dramatically after bad event C, and good event D must be very weak because it didn't push prices very high. And so the idea is to perhaps forecast and assess these events to identify where stock prices will go. There are lots of problems with this approach. One is that it's very difficult to find any single person or any single investment firm that can accurately forecast the events, the good and bad events, and how the market's going to respond. There will be investors who can do that for a period of time, over a couple of years or so, but then it might appear that they have a cold hand and are no longer successful in doing so. So timing the market and timing these events is viewed as being very, very difficult. But if we focus on resilience, the resilience of the market, and that's the enthusiasm of the market, that can be done more systematically. And the idea behind resilience is that in a resilient market, prices recover quickly from bad news and events, and there's support for higher prices. So the bad things happen, but the rebound is complete and quick. And so during this period, through various measures, we can identify if prices are moving higher because of resilience. And in this hypothetical example, I'm saying that resilience is actually what's driving prices higher. Yes, the bad events A and the good events B influence stock prices, but the major influence on the trend is the market's resilience. In the latter part of this diagram, the market has low resilience or high vulnerability, and bad event C is therefore seemingly driving prices quite a bit lower. The good thing about resilience, it's based on readily available data, and this allows testing over a long period of time. It's very difficult to assess events over a long period of time, but we can look at resilience over as much history as there is for a particular index. And the changes in resilience are rhythmic. There's a cyclicality to them. Now, importantly, panic selling tends to set in during periods of low resilience. So we tend to move out of stocks when resilience is low, because if panic is going to set in, that's going to be the time. The market resilience indexes are what we use to measure resilience. The brown line is decomposed into the larger trend, and the macro market resilience index measures the longer trends, and those trends usually last for several years, and the level, direction, and slope of that macro MRI are important. The exceptional macro is an alert on the slope change of the macro, and so we want to know when the macro index is likely to turn positive, and that's the primary purpose of the exceptional macro, is an indication that that may take place. The micro MRI is like a heartbeat going across time, and the cycles are rhythmic and fairly consistent over time. So these MRI indexes give us a good idea of where we are relative to historical norms for a given index. Resilience is a function of the views and enthusiasm of investors worldwide. The more views, the better. So unlike investment approaches that depend on finding some overlooked opportunity or threat, this approach works best on widely followed indexes like the Dow Jones, and the approach is more helpful for the very liquid, widely traded indexes. Resilience is measured by the small market price movements and return changes that take place in the index, so it's driven by price movement as opposed to price levels. At its simplest level, the approach buys low and sells high on the MRI. We're not trading the price because the price is influenced by the good news and bad news events that are at play at any given time. So making a trade on the resilience levels is a much more reliable way to make buy and sell decisions than looking at price. But in general, if there is a cycle of resilience shown by this green line, a downward trending line indicates a lack of resilience, an upward trending line indicates resilience is there and pushing prices higher. We wait for the bottom, for the trough of an MRI, and buy as it's moving up. And we hold it as it's moving up, and we will sell when it arcs over, establishes a peak, and we will sell that asset in the declining leg of this cycle. This chart shows the actual MRI for the period 2005 to 2009, and this is at the time of the global financial crisis. The brown line indicates the Dow Jones price level. The blue line is the macro MRI, indicating the long-term trend, and the green line is the micro, indicating the short bursts of resilience on the up leg that take place over time. Or the diagram in the upper right-hand corner shows the stylized versions of those, and this chart is looking at all the different MRI. My innovation is that the peak in the macro MRI coincides nicely with the peak in prices, and the peak in the micro MRI coincides with a local peak in the index. If we combine the influences of these two MRI, we get a pretty good indication of how the market is going to go. When the macro trend is negative, we have a pretty good idea when the short-term micro MRI ceases to be positive and move down, that prices will decline dramatically. So this was an expected move. This is an expected move. So these indicators can let us know what's likely to take place in terms of a rebound after any kind of negative news. This slide shows the price level of the Dow Jones on a log scale, moving from 2000 to 2017. This is the decline of 2002 and 3, the peak in 2007, the decline that bottomed in 2009, and the subsequent run-up in prices. The exceptional macro is shown as vertical green lines on both series, and I'll come back to that in just a moment. But the macro MRI is shown in the lower panel, and you can see that it coincides generally with the peaks and troughs of the price levels. So for example, when prices peaked in 2007, that coincided with a peak in the macro MRI. So at this point, I had an idea that the market would be vulnerable and that dramatic price declines could take place. That happened again in 2015. The macro MRI peaked, and there was a general peak in the prices in the Dow Jones at that same time. Now, on the buy side, when the stock market declines, the appearance of the exceptional macro is a good indicator that it's time to seriously consider getting back into the stock market. And the line that is shown here, the vertical green line, or that precedes a trough in the stock market that is followed by a major run-up. The same occurred in 2009. The appearance of the exceptional macro coincided with and then a longer run up in prices. And it occurred in 2016. Actually, the exceptional macro occurred and the macro MRI turned positive very quickly, and that began this longer term move higher. This is a pretty good indicator of the tops and bottoms, the major tops and bottoms of the stock market. But if we add the micro MRI, we get higher resolution. And if we look at just a couple of these, the appearance of the exceptional macro indicates that it's time to get back in, but the micro, indicating the short-term trend, indicated that there was a short-term peak in resilience. In 2009, the same thing occurred. The exceptional macro began right at the peak of a micro, and prices moved down in concert with the decline in the micro index and created a good buying opportunity here. This diagram shows the price history of the Dow Jones Industrial Average going back 100 years. And this is on a log scale, and that means that the graphical distance here, shown by this red diamond, these market declines were about the same percentage points. Now let's review a little bit of market history. This is 1920, and it goes to 1929, the Roaring Twenties, the big crash, going to 1933. The long market recovery, it took about 25 years to recover prices from this point on. Prices moved up after the war period to 1966, then a period of high inflation, and prices began to move higher in 1981 and moved to a peak in 2000 at the internet boom, a decline after the internet boom, and then the peak just prior to the global financial crisis, the decline in 2009 and the subsequent recovery. If we trade on the MRI, buying low and selling high on the MRI, looking at the micro, macro, and exceptional macro together, we can make trades that give this green line, holding stocks when the stock market is resilient and holding cash when it's vulnerable. And we can see that there are declines in the green line, but the overall pattern, again, is very positive. The key points from this set of slides are that the approach is responsive to current market dynamics. We're looking at the current levels, directions, and upcoming inflection points of these different market resilience indexes. There are no long-term forecasts of events. We're just making a short-term forecast of where resilience is going over the next 1 to 6 weeks. There are lots of false alarms, but because trading is cheap, we'll move out when the market appears to be vulnerable and then get back in when it looks like it's going to become resilient.